Business confidence has taken a dip. That's as the RMB BR morale indicator declined by 2 points to 31 in the fourth quarter. The decline follows a sharp deterioration in sentiment among new vehicle dealers. Confidence levels among new car dealerships slipped to the lowest point since the early days of the COVID-19 pandemic, suggesting that consumer spending was taking strain from the high interest rate environment. Traders also reported on very high inventory levels, according to the survey. Telkom is in exclusive negotiations with a preferred bidder on the possible sale of its masts and towers business, Swiftnet. The telecom company says the bidder is a consortium of equity investors, which includes a black economic empowerment partner and is led and managed by a reputable private equity firm. The move is part of Telkom's strategy to reorganize itself as an infrastructure company as a way to drive growth through consolidating core assets. This process is expected to be in full effect by the end of 2025. Telkom has also opened its books. The firm has posted a 46.7% jump in interim profit. That's thanks to lower depreciation charges and growth in core profit. No dividend has been declared. Southern Sun has reported a dip in interim profit. For the half-year, profit fell 24.2%. That's despite the hotel group's occupancy rate improving along with the number of rooms sold and the average room rate. It's the firm's overheads that weighed on profit. Southern Sun faced increased operating costs during the period, thanks in part to load shedding. Looking ahead, the firm is hopeful that South Africa's ability to attract international events will continue to support its business. But the group has cautioned that this is only possible if the country can supply uninterrupted power. And while they have been promising steps towards solving that challenge, eradicating it will take time. Coronation believes the outflow of money from South Africa will continue as long as unemployment remains high and households face greater pressure. That's because the tough environment will prompt investors to look elsewhere to park their money. The fund manager has seen this reflected in the group's results, with net outflows for the year amounting to 10% of average assets under management. In other financials, fund management earnings per share fell 57%. That's largely because of the company's dispute with the Revenue Service that will be heard by the Constitutional Court. Excluding the effects of the case, fund management earnings per share declined 4.3%. The Supreme Court of Appeal found in February that SARS was within its rights to claim taxes from the company for income earned by its Irish subsidiary, stretching back to 2012. The decision paved the way for SARS to claim additional taxes in respect of profits earned by international operations, together with interest and costs. The tax bill is about 800 million rand. Momentum Metropolitan has got the year off to a good start. For the first quarter, the Insurance and Investment Group has delivered an 18% rise in the present value of new business premiums. Looking ahead, Momentum Metropolitan says it remains concerned about the impact of the slow pace of economic recovery and high interest rates on disposable income. This is likely to put pressure on new business volumes and persistency, particularly in Metropolitan Life. To counter this, the firm's focus will be on driving sales volumes and on improving the sales mix. Transnet Port Terminal says it has lost 160 million rand since September due to a backlog at the Durban harbour, and it's likely to lose more. Around 63 vessels are still anchored and waiting to be processed. TPT has blamed poor weather conditions as well as equipment breakdowns and shortages for the delays. Transnet Chair Andile Sanqu has stated that the problem of port congestion is a complex one and has happened due to many years of underinvestment in equipment and its maintenance. But a number of measures are being looked into to turn around the situation. It will, however, take some time to do so. Business Unity South Africa has called on Transnet to urgently resolve the crisis, saying the state logistics firm must improve its performance or the South African economy will continue to bleed unnecessarily. Social Development Minister Lindiwe Zulu says her department plans to take its proposed basic income support policy to Cabinet before the end of this financial year. She says the 350 Rand Social Relief of Distress grant will form the basis of what will become the Basic Income Support Grant in future. This comes as concerns have risen about the affordability of a basic income grant given the fiscal constraints facing government that were highlighted in the recent medium-term budget policy statement. Further afield, McDonald's has struck a deal to ramp up its stake in its China business to just under 50%, expressing confidence in the burger chain's growth prospects in the world's second largest economy. Let's take a look at this report for more.
McDonald's has got a taste for growth in China. The US fast food giant says it has struck a deal to ramp up its stake in its Chinese business to 48%. The deal sees McDonald's buy out a 28% stake held by Carlyle Investment Group. The move is in sharp contrast to other multinational corporations. Many have pulled back investments in China or even left the market altogether due to geopolitical and economic worries. But McDonald's chief executive Chris Kempczinski that he believed there was no better time to capture higher demand in what he called its fastest growing market. Financial terms were not disclosed, but two sources said the deal values the China unit at around $6 billion. That's far more than its valuation in 2017, when McDonald's agreed to sell 80% of the business for up to $2.1 billion. Since then, the number of McDonald's stores in China has doubled to 5,500, and the country has become its second largest market. It aims to have more than 10,000 stores there within the next few years. McDonald's further said the business has generated sales growth of more than 30% since September 2019. A consortium led by state-supported conglomerate CITIC still has controlling ownership of the China business with a 52% stake.
And leaders from a number of African countries are in Germany for the G20-backed summit that seeks to strengthen ties between Africa and G20 nations. Here's our reporter Ndawuleng Lechela with more.
That's right, Zinati. Germany is hosting an investors conference in Berlin under the G20's Compact with Africa initiative. The gathering is part of the German government's commitment to support African countries in making economic gains. And joining me now with on-the-ground insight is Lars Halter with Deutsche Welle. Thanks for your time today. Now, Lars, let's get straight into it. What exactly is being discussed at the summit?
Yeah, thanks for having me. Well, maybe the main point from a German perspective, they're really seeing a whole new level of potential partnerships with Africa. And while that has been said before, things are different now. There's Russia's war in Ukraine, there are challenges with China, and the urge for Germany and many other countries to de-risk from that country. And there is a big need now for new supply chains. And that is what they're looking at in Africa. When talking trade, however, it should be clear that the decades or even century-old concept of Africa selling raw materials alone is no longer working, nor is it attractive. And Ghana's President Nana Akufo-Addo says that a much larger part of the value chain has to remain in Africa, and German Chancellor Scholz agrees. He says if more of the value lies in Africa, it creates jobs there, strengthens the continent's industry and economy, and makes companies there stronger and better trade partners for German and other European companies as well. On another note, one particular trade Germany is interested in, hydrogen. Chancellor Scholz talked quite a bit about that, promising Africa in broad terms that Germany will buy green hydrogen in large quantities. And he's encouraging African nations to invest heavily in that sector and become a major supplier to the world.
Now, a lot of analysts say these summits are all talk. What's the sentiment on this one, Lars? Is the compact with Africa really helping Africa?
It's complicated. One thing is clear, the Compact for Africa is a great project by the G20 and it could well be a game changer, but it's only been around for 6 years, so it's really hard to say whether in that relatively short period of time a lot has really happened or if there's much tangible progress. Anyway, active trade is important for Africa, whether that is trade within through the long-planned African Continent Free Trade Area Agreement or whether it's trade with outside partners. The problem is there are experts that doubt how much investment will actually flow to Africa. A colleague of mine spoke to an economist out of Nairobi, and he told us that the fundamentals on the ground in Africa are just often not favorable for investment by private companies. A lack of infrastructure, political instability in many countries on the continent, a lot of serious problems that remain there that make investing difficult.
And how important is this meeting for Germany, Lars?
It seems to be tremendously important. Not only is this gathering one of the largest economic and trade conferences Germany has seen in a long time, but it's also the current geopolitical environment that makes this crucial. Again, looking at China, you can't talk about China and Africa without mentioning the Belt and Road Initiative. China has heavily invested in infrastructure in Africa over the past few years, and other economies have been sidelined. That is something Germany would like to see changed, especially when learning that lack of infrastructure is basically the reason why massive private investment is just not happening. Infrastructure needs to be built, but obviously not exclusively by China, for more than one reason. Of course, from a German perspective, or generally from a Western perspective, you don't want China to be able to expand its influence unchallenged. But also from Africa's perspective, the deals some countries have made with China often don't seem to be in those countries' best interest, whether it's environmental damage, huge costs to service loans, or just generally the long-term dependency many find themselves in with China. Those are all problems that have been complicating business in Africa.
Well, let's leave it there. Always appreciate those insights. That was Lars Halter joining us from Berlin.